Nifty trades flat around the 21,900 mark, slips from opening highs. Meanwhile, Sensex trades above the 72,300 mark, up around 200 points.
And all sectoral indices in green except for tech and autos. IT top sectoral laggard, realty pack building gains. Top sectoral gainer up 2%.
Stock of TRF hits the upper circuit after it calls off merger with Tata Steel, sees business performance improve in the last few quarters as well.
Paytm continues to gain for second straight session. The stock has hit upper circuit in early trade, currently trading with gains of almost 9%.
Shares of Britannia fall over 1% as regional players give tough competition, eat into its business. Profits dip 40%.
And Brokers Body President Vijay Mehta tells NDTV Profit that an extension to trading hours of derivatives was unanimously approved in a board meeting. That's an NDTV Profit exclusive. Hello and welcome. You're watching Market IQ on NDTV Profit. I'm Smriti Chaudhary and with me is Hersh Sayta. And for the next 30 minutes, we'll bring you all that's happening in the markets at noon. Let's take a quick look at the markets. Well, we started on a very strong note above 22,000, but now we have slipped into red for the benchmarks. Nifty 50 is trading 0.1% down at this juncture. If you look at the broader markets, continue to trade in green. Mid-cap index up about 0.3%, and Nifty small cap up about 0.5% in trade. Now let's also look at some of the gainers within the Nifty 50. The biggest gainer today is SBI, that's up about 3.5% in trade. And if you look at the other gainers, we have JSW Steel, that's also up about 2.5%. SBI, up 3.5%, followed by JSW Steel, that's up 2.5%. There's Britannia that came out with its results, also up about 2%. We have Nestle also, that we recently saw the results. The share is on a up about 1% thereabouts, so a little bit of a positive in the FMCG sector, even though there is still concerns around rural demand. Now let's look at some of the losers as well. We have IT Pack that's leading, that's the biggest laggard today actually, with the Infi down about 2% in trade, Power Grid down about 1.5%, followed by TCS also down about 1.3%. If you look at the breadth of the market, if we can get the advances and the declines, we'll be able to see. If you in the morning we started pretty strong with the advances kind of taking over, and in the middle it was pretty much flattish, flat as a pancake, as one of our colleagues said in the newsroom. And now it's still kind of in favor of advances, but it has kind of closed down between the two. The gap has closed down. So that's where we are on the markets front, Harsh.
Well, absolutely, Smriti. It's it's a mixed sort of day, but it's something that we'll take home after the kind of week that we've had last week, as well as on Monday and Tuesday. But let's quickly move on. Top headline within the M&A space: TRF has actually called off its merger with parent company Tata Steel. TRF shares on the back of that announcement have risen 20%, and Varsha Chandani is going to bring us all that's happening and what's really pushing the stock higher, in fact 20% higher. Varsha, talk to us about what's happening in this space.
So hi Hersh, so as you rightly said, company has shares as at 20%. Now this is after the calling of merger with Tata Steel. Now if you see, this announcement was made somewhere in September 22, and since then Tata Steel has been providing operational and financial support through infusion of funds in TRF. Now Tata Steel says says that TRF is witnessing a turnaround in its business performance, so amalgamation may not be needed. But from the TRF perspective, if you see, when merger was announced, the swap ratio was unfavorable. Like TRF shareholders would have got 17 shares of Tata Steel for every 10 shares held. So considering the yesterday's current closing price, if you see, shareholders would have lost 10% if this deal were to be happened.
Thank you, Varsha, for that. TRS hitting upper circuit, but we have another stock, EIH, that is also locked in upper circuit, and that is after it posted strong set of third quarter numbers. Anushi is here joining us to tell us a little bit about what the numbers are. How does it look like? Anushi, please decode the numbers for us for EIH.
Right. So as you mentioned that the stock did hit the upper circuit, which is like a 20% gain, but it has cooled off from those early day gains. Now it's like trading at about, still it's seeing a handsome gain of about 15%. But this was on the back of the Q3 numbers which came out, wherein it posted a strong set of numbers beating the market expectations, with the revenue seeing about a 26% upside to 741 crores. And even the EBITDA and margins over here is on special focus, with margins inching up to about 811 basis points to 43% compared to 35% earlier. Same with the net profit. Net profit also saw about a 52% uptick. So just to analyze what was happening, we can see that the occupancy was up by about 2%. To 79% compared to 77% earlier. Supporting this was the average room realization in the hotel industries, which is seeing a stronger growth, with the ARRs, that's the average rate realization, rising up to 19% at 19,000, which if we factor the occupancy, those two factors have brought in the RevPAR about 23% up. Also now, if we are to just look at overall what the company has been doing, one of the key strategies that they're adopting is the debt reduction over the few quarters. So they have been in the net cash positive status since June 22. And we have seen that right now, if you look at the net cash, that stands at about 684 crore compared to 256 crore. Again, for future, what remains on the radar is the company's strong expansion plans, wherein they plan to add about 50 hotels by calendar year 2030. And still, the foreign travel influence, that the number is still lagging the pre-COVID level, so that can again add to another growth opportunity for the business. So overall, the stock performance, just to end on that note, the one-year return has been 143% for the EIH Limited. So definitely a strong focus on this one.
Right, thanks for that, Anushi. It's been a day where everyone is looking at earnings, and that's been the focus. I want to quickly flag off how Trent is doing in trade, because they've come out with their numbers, very strong set. You can see the spike on the stock, almost 7+% higher as we speak, was up 8% few minutes back. Quickly, with regard to the revenue, it's come in around 15 to 20% higher than expectations. EBITDA has actually doubled up. We've seen margins also go up by around 400 basis points on a year-on-year basis. Very strong set of numbers. And profit after tax has more than doubled. I think from around 150 kind of crore number, it's come up to around a 370 crore number on a year-on-year basis. So we've seen very strong numbers come in from Trent. Of course, Nestle as well disclosed its numbers. That stock in focus as well. If you can quickly pull up the charts and understand where, there you go, a bit of a spike on Nestle as well. So both of those stocks on the back of numbers seem to be buzzing. Frontline stocks. We'll, of course, as details start pouring in, we'll quickly give you a review on Trent as well. But the other stock we're going to be focusing on is V-Mart. That one also is up roughly 5% on the back of very good set of numbers, now 3. Just to kind of break this down, net profit jumped over 40%. Mahima is here to add more. Give us context, Mahima, what's exactly happened with regard to V-Mart?
Right, Hersh. So as you rightly mentioned, the net profit has jumped over 40%, and also sequentially after 3 quarters, V-Mart has recorded a net profit overall. Last 3 quarters, it was running into net losses. So that is why the stock has been in focus today. If we talk about the numbers overall, revenue has gone up by 14%, EBITDA has gone up by 15%. And what has led to this growth? V-Mart has witnessed a very good festive demand season, because of which the footfall footfall grew by over 23%, and also their like-to-like sales has grown by 4%. Overall, 20 new stores were added in Q3, and their Lime Road has also reduced its losses by 29% sequentially, which has worked for V-Mart in this quarter. And overall, if you see, other expenses have gone up by 25%. However, the working capital has significantly improved and decreased, and inventory has been decreased by 12%. So overall, the picture for V-Mart for this quarter looks very good.
Right. Thanks so much for that context, Mahima. V-Mart on the back of that, 3% higher. Coming back to Trent, we had a profit estimate of 260 crore. That's a substantial beat that Trent has delivered to profits. Margins were expected to be around 16.5%. It's come in at 18+%. So definitely that 6% uptick seems to be justified, at least as we speak. Very, very strong numbers. Of course, we'll have to wait for management commentary to come through. But a 50% growth in revenue, very good set of numbers coming in, and the stock reaction justifying that.
For sure, we'll be tracking the trend and what the management says. And we'll bring you all those details. But shifting focus to brokers body, the Association of National Exchanges Members of India approved extension of trading hours of derivatives segment. Saloni Kothari joins in with more details on this. Saloni, what are you picking up on this?
Right, Smriti. So brokers have now agreed to send a combined recommendation to SEBI. Now, why this is important is because last month, SEBI chairperson had said, and even Brokers Association, they have said that they were having issues to come up with proper recommendations. They were facing issues from the small brokers also with respect to resolution of operational matters, as in how operationally it would work for big brokers as well as small brokers, and also related to margin, which would arise post the introduction of these extension of hours, and also issues related to the price settlement which needs to be sorted out. So all this according to, and we spoke to Vijay Mehta also, who's the president of ANMI. So he said that all this have been discussed properly, and now they will send these recommendations to SEBI. Now this doesn't mean that obviously the proposal is done and we will be soon having an extension of hours. The SEBI now will obviously review, and they will have a consultation paper, and then after that they will also take investors and public feedback on that, and only after that will we see what actually happens from there, and also we'll await what exactly recommendations point by point are the brokers trying to make, and if it actually makes sense or not.
All right, thank you, Saloni, for that. Saloni, just point out that this does not mean that this proposal has been approved. They've just given recommendation. There's going to be a consultation paper, then there are going to be public comments, and then it may come into play or it will be implemented. But we'll slip into a short break for now, and we'll bring you more updates on the other side. Stay tuned.
Welcome back. You're watching Market IQ here on NDTV Profit. Thanks for staying tuned with us. We continue to focus on stocks in this particular segment where we give you more insights on what's happening. And, we'll switch focus to Go Fashion. The revenue has surged 15% in the third quarter. And on the other hand, you've seen net profit of the company dip by 4% in Q3. My colleague Alex spoke to Gautam Saraogi, who's the ED and CEO of Go Fashion India, and began by asking him the key highlights of the third quarter. Listen to that particular piece.
This has been a good quarter for us. We've reported a good top-line growth of 15% on a YOY basis. In fact, this quarter, we've also seen an increase in our gross margins. We've seen a 100 to 150 bips increase in our gross margins. But however, our operating margins have taken a small hit this time around. That's largely because of our same-store sales growth being flattish. And because our same-store sales growth has been flattish, the cost in those historical stores have been slightly higher this quarter as a percentage of revenue. And that's why we've seen our operating margins taking a hit to the extent of 200 to 250 bips.
What you're saying is that the new stores that you're opening are effectively more efficient than the earlier stores? Is that how to understand this?
No, that's not the right way of looking at it. See, the new store, usually when we open a new store, it goes through a maturity period. So the new stores what we have opened during this quarter have done fairly well. It's just that the historical stores what we have not seen a big revenue jump on a YOY basis. It's been flattish. And that's why the costs in such stores have been higher.
Understood. But there is quite a substantial increase in the number of stores you're introducing as well. As I understand it, you are planning to add as many as 120 to 130 every year. What is the kind of cost that you're setting aside to set this up, and how many are you planning to open in the last quarter?
So see, our original plan for this year was about 120 to 125 stores. We will be falling short of that a little. So we would be ending up with 105 to 110 stores net additions this year. Last year, we had opened about 120, 125 stores. For a very long time, we've been opening 120 stores every year. We feel there's a large runway for the number of stores we can add. Today, we are at about 700 stores. As a brand, we see opportunity of having more than 1,500 Go Color stores across the country. So keeping that large vision of number of stores in mind, I think 120 plus stores a year is a good, healthy number for us in terms of additions.
That was the management of Go Fashion talking about how they'll fall short of store openings this year. And we also spoke to Adani Gas Management, Satinder Pal, about the current status of the company's projects and the growth outlook. Here's a slice of that conversation.
We made a very strong start to our business in Dhamra, not least because of the enormous amount of effort and experience that people put into this project. Since the time we last met, we have stabilized our operations. We've imported 15 commercial cargoes till date. I think 10 from GAIL, 5 from IOCL. We are at about 52% capacity utilization in the first year, which, if my numbers are correct, makes us the second most utilized terminal in India this year.
So, given you have already got 15 cargoes, what are your plans and what the kind of demand you foresee for your terminal?
So, Vikas, it is quite instructive to note that Dhamra is the closest LNG terminal for 35% of India's population. We are the only terminal in Eastern India, and with the unification of gas tariff in the pipeline by PNGRB last year, we are really very well placed to definitely service the eastern market, but also the northern and soon the southern markets which will be connected. This, coupled with the fact that there has been a considerable softening in global LNG prices in the last few months, and of course the Honorable Prime Minister's vision, which he reiterated today, of increasing the share of natural gas in our primary energy mix to 15% very soon. All of these three factors actually are very good factors for us when we are looking to grow our business. I see a very robust role for gas, in particular LNG, in the coming months, and that is going to be a step towards decarbonizing our entire industrial sector, and also will be in the long term more economical because LNG is definitely going to be cheaper than some of the liquid fuels it will replace.
Who are our main customers, main buyers of the cargo that we are getting? Is it only getting consumed on the eastern front of the country, or you are also looking at northern and southern India?
Yeah, thanks, Vikas. As you know, our capacity has been subscribed to by Indian Oil and GAIL. As I understand, Indian Oil is taking this LNG for use in its refineries primarily. GAIL, of course, is also taking it to service its demand in the fertilizer sector and also other customers. Most of the gas at present is being consumed in the eastern part of India, but there have been instances where the gas has actually also flowed to the north. There are no technical constraints to more gas being flowing to the north. And as the throughput increases, we fully expect LNG from Dhamra to find its way not just to the northern parts, but also the southern parts, of course, in addition to the eastern sector.
That was the management of Adani Total Gas, but Vascon Engineers just came out with its results and the stock is down about 5%. Now, if you look at the results, the revenue is up 10% to 280 crore. If you look at the EBITDA, that's up 27%. Margin also increased to 9.6% versus 8.3% in the last year, like the corresponding quarter of last year. Net profit also up 14%. However, market reacting very sharply to it. Hersh, the stock is already down over 5% in trade.
Absolutely, under some amount of pressure there, Vascon Engineering. Quickly switching focus though, Vikas also spoke with Ashu Singhal, the MD of Mahanagar Gas, about the company's expansion plans and capacity building. Listen into a slice of that.
We have already recently commissioned one LNG retail outlet at Savroli, which is on Bombay-Pune highway. And last year we have formed a joint venture company with Badrinath LNG, which is a 51% stake of Mahanagar and 49% of Badrinath. So we plan to put up 6 stations in one calendar year or so. So the acquisition, the land acquisition and other processes are already on. And we expect that within 1 year we will be able to commission 6 more stations. The capacity typically is that depends on the tanks we put. It can be 20 kiloliter or 20,000 liter capacity tank or a 50,000 liter capacity tank. So we have to yet to design, and it depends on the potential market there that we design the outlet.
So who are the potential buyers for this kind of LNG that we look at?
See, there can be several buyers because heavy trucks which operate on a circular route, like cement factories or fertilizer factories, where the truck pick up the luggage and goes to the destination and come back. Mining is one such application. Typically, LNG can replace diesel in the long haul because one fill of LNG can run almost up to 900 kilometers of distance, and it is cleaner as compared to diesel. So potentially we are looking at a market which is currently being handled by diesel. So that can be replaced by LNG.
So have you already tied up with such players who are going to be customers, or it's like, as you come serve basis?
Already we have signed contracts with Green Line who are applying LNG trucks. So they are picking up LNG from our Savroli station. Around 4 tons per day sale is happening from Savroli. Going forward, when we are, Maha LNG is the new company's name which will be installing more stations. So in that localized area, we will see which are the companies. So Green Line can be one more potential. Concor is another one, and few more companies directly we will contact, that whosoever is interested, we will sign the contracts with them.
By when you see this company to contribute to your total, turnover?
It's a small company, new initiative. It takes some time, maybe 2-3 years. But the revenue generation will start after completion and commissioning of these stations. So maybe 2 years down the line, we expect that some revenue will start generating from this company.
Right. So those were some conversations that we had with managements as well, but that's all we have on the show for today. Stay tuned to NDTV Profit. Thanks for watching Market IQ. From myself, Smriti, everyone who puts the show together, thanks so much for watching.
Hi, thanks so much for joining in. You're watching the Mutual Fund show on NDTV Profit. My name is Alex Matthew. Like the name suggests, this show gets you actionable insight on everything related to mutual funds. And often we talk about the way that mutual funds are managed as well. So today, one of the primary focuses is going to be a potential change, something that might just be in the works, and how that will change portfolio construction or approach to portfolio construction by fund managers. We're joined by Chirag Mehta, who's the CIO of Quantum AMC, and we will soon be joined by Nikhil Kothari, who's the director at Etika Wealth. Chirag, thanks so much for taking the time, and pleasure speaking with you on NDTV Profit.
Thank you for having me. Pleasure to be here.
So we're having what is very obviously a hypothetical conversation right now, because there is a source-based report out there that suggests that there might just be a bid or a suggestion by the industry to the regulator to reclassify the market capitalizations and the definitions of large cap and mid cap. Currently, you have large cap is defined as the first 100 stocks and mid cap as the next 150 stocks. But the reasoning that has been given is that we've seen a significant rise in the markets since COVID-19 lows. And what was a large cap then is in fact a mid cap right now. So what I'm trying to understand in this conversation is, would this materially change the way that you approach portfolio construction? Why is this a requirement? So that's the first question, Chirag.
Yeah, so the argument you just laid out that, given that some large caps would have become mid caps, so from that construct perspective, still it is a subset of 100 stocks, right? A large cap is still 100 stocks, mid cap is still 150 stocks. So number of stocks may have moved from one end of the curve to the second end, but overall still the subset remains 100 and 150 stocks in each category. The issue is that large cap funds have a restriction of 80% to be held in large cap stocks. And therefore, given that there is a churn, for example, last year, we saw a churn of 14% moving from large cap to mid caps, which from that perspective leaves little room for fund manager to have enough flexibility to kind of rebalance their portfolios. So there will be some, say, 3 to 5% cash for liquidity purposes held by the fund. There will be churn that will result into that 14% impact in terms of changes in allocation. So to meet that 80% threshold becomes to that extent difficult when market dynamics are pushing many stocks from large cap to mid caps. So I think from a large cap perspective, there is a need to have some more flexibility moving into the threshold levels. Like 80% is a high threshold level to achieve when market dynamics are changing very, very fast. In years when you have churn ratios of 2 to 5%, probably that's easier. But when you have churn ratios which are very high because of market cap changes, that leads to relooking at the classification. But however, for mid and small cap funds, there is a leeway of 35%. So from that perspective, there is enough wiggle room for these funds to maneuver out and ensure that they meet those thresholds. But for large caps, probably there is a room or a merit in relooking at the classification the way it's given.
So if you do hypothetically change the classification and you have, instead of 100 stocks, you increase it to 125, for argument's sake, Chirag, from my perspective, the challenge of that would then be, how do you benchmark it? Because right now you have a lot of funds in the large cap actively managed space that benchmark to the BSE 100. But if you change the base or the pool from which you choose the stocks to 125, would benchmarking then become difficult?
Not really, because if you see, benchmark is just a barometer of what that space is doing, right? So if you have a pool of 125 and you benchmark to 100, still it occupies much of the market cap that lies in the 125, maybe leaving around 10% away, additional for that 25 stocks. So overall, you still will be capturing 90% plus of the market cap, even if you compare with a pool of 125. Similarly goes for example, small cap. Small cap has about maybe 3,000-4,000 stocks, and you are benchmarking to 250 stocks. Is that good enough or not? So I think benchmark acts just as a barometer, and 125 stocks benchmark to 100 stock index, I think that still justifies because it captures much of the market caps available there.
Okay, so I think that more or less covers that topic. But while I have you with me, and this is something that I like to do with all of the representatives of funds that speak to us on this particular program, is to try and understand how your portfolio construction works. Would you be able to describe the ethos that you follow when you're selecting your stocks?
Sure, and I will relate it to the topic that we are discussing. Much of the requirement for flexibility emerges when you have, funds AUM rising much more than the market cap and liquidity of the underlying pool that you're tracking. For example, the mid and small cap have, increased, the fund size have increased by about 250 to 350%, anywhere in that range. Whereas if you see the market caps of these companies have only risen by about 230%. So that is over last 4 years. If you were to look at why these flexibility requirements are emerging now, is because the fund sizes have crossed the capacity levels to some extent, of which they can deliver a meaningful portfolio, keeping into consideration the market cap and liquidity requirements that are needed for managing these strategies. And that is where you have that ask, to relook at the classifications. So at Quantum, we are very, very aware of the market cap and liquidity criteria. So in our large cap oriented offerings, we kind of look at liquidity as one of the first criteria to filter out stocks. So any stock that trades only $1 million a day on a liquidity over last 12 months is only included in the universe that we track, so that we can scale the fund to a size without compromising on the portfolio characteristics of the fund. Another thing that we look at is governance is very important criteria. If governance is not up to mark, we would not invest into those companies. And thirdly, from a valuation standpoint, it should make sense in terms of the upside it leaves on the table after normalizing the numbers over a period of time. Because in a bull market, it's easier to get carried away. Whereas if you normalize numbers, probably it gives you a realistic picture. So those are the things that we look at: liquidity, governance, and valuations as a predetermined factors that should tick when we select a stock.
Okay. So that gives me an overarching framework, but when you look at the and this is essentially my last question right now, if you look at the valuation picture right now, are you sanguine? Are you comfortable? Are you holding more cash in your portfolios right now, and will that be your approach in the near term?
Yeah, so valuations are getting expensive by the day as markets keep moving up. Companies are delivering good in terms of earnings growth. So we are seeing that support from the market, and therefore long term, if you look at the P ratios of index, are slightly above only over the long term averages. But given that we are bottom up stock pickers and we look at stock specific ideas, we still see some room for our portfolio to provide some upside in stocks. So yet, we haven't increased our cash levels as yet because cash is just a residual of our process, and we still see upside in our stocks. So we are staying put at this point in time. But if markets keep rising, probably we'll be compelled to sell because there will be no upside left into those stocks, and therefore our cash levels may rise. But at this point in time, we are still looking at more upsides from our portfolio companies.
Fantastic. Chirag, thanks so much for joining us on the Mutual Fund Show. Pleasure speaking with you. All right. And by the way, Nikhil's joined in the interim. Nikhil, thanks so much for joining us. We will have a conversation about arbitrage funds as related to systematic transfer plans, because as Chirag just pointed out, valuations in certain pockets are getting just a tad bit stretched. So we will take that up after a very quick break. Viewers, do stay with us. Welcome back. You're watching the Mutual Fund Show. Now, a few market watchers have pointed out that valuations in certain pockets of the equity market are a little stretched. Now, from the perspective of a retail investor then, you need to be a little bit cautious when you're deploying large sums of money. How do you maneuver in this scenario? You usually use an instrument, or rather a method of deploying funds, called the systematic transfer plan, that allows you to invest in a particular scheme of a mutual fund, which then deploys funds periodically into another scheme of that same fund. That's the definition of a systematic transfer plan. We'll talk about how you should employ this and in which situations you should employ this. To talk about this in more detail, I've got Nikhil Kothari of Etika Wealth joining in. Nikhil, thanks so much for joining us on the Mutual Fund Show. I do want to start, before I get into STPs and how you use it, I want to get into the fund that you use to use that STP, which is traditionally a liquid fund or a fixed income fund. But the taxation or the tax treatment of these fixed income funds has changed. So from that perspective, should you rather use an arbitrage fund because of the tax advantage? And what do you need to bear in mind? So the first question is, what is an arbitrage fund?
Okay. So arbitrage fund, as the name speaks, it gets an arbitrage opportunity that there may be a price difference. So basically, on last Thursday of every month, the future market price and the cash market price become same. So what arbitrage fund does is that they buy in cash market and immediately sell in future market. And whatever is the difference is the return which they will make. Okay. And in the last few months, what we have seen is that the rollover spread has increased, and arbitrage fund are giving return upward of liquid fund returns also, and since whenever the markets are volatile, you get a lot of arbitrage opportunity, and arbitrage fund keeps on deploying in those opportunities and making a return which is a risk-free return if you hold the position for the whole 1 month. So there's no risk on the downside, and it gives you a risk return if the fund holds the position for one complete month.
Understood. Now, the question that I need to ask is that because the management of the arbitrage fund is in the equity markets, and you're talking about buying in cash and selling in futures, so therefore the underlying is equity. The question is there a risk of capital loss, and is that something to worry about at all? And what is the degree of volatility of returns that you will get from an arbitrage fund? What impacts that return?
Okay. So basically, see, if, as I discussed, that what they do is that, say, for example, the cash market price, Reliance shares is trading at, say, 3,000 rupees. And in future market price, so that which say last Thursday of the month, and the future market price is 3,100 rupees. So what the fund manager does is that he buys in 3,000 and immediately places an order to sell on futures market in 3,100 rupees on last Thursday of every month. On last Thursday of every month, whatever the price, if for example price goes to 3,500, he makes 500 rupees profit in the cash market, he makes loss of 400 rupees in the futures market, and overall his gain is 100 rupees, which is logged in when he did the transaction. So in a whole month, if the positions are rolled over, there's no concern of making a capital loss. But during the month, what can happen is that the future market price can go up and can go down, and the cash market price also fluctuate. So because of that, in between, arbitrage fund may show you some volatility in terms of return. But if you hold for the whole company, when the position gets closed on the last Thursday of every month, the cash market price and future market price become same. And whatever price you have done the transaction the first day gets logged in the same thing. So you don't make any capital loss if you hold the position for the complete 1 month. So you don't have to worry about the loss of principal. What you need to worry about the interim volatility, because if you say, for example, investor and only investor for 15 days, you may see some volatility in the return. But over a 1 month period, you get return in line with your liquid fund returns.
Okay, but at the same time, the tax treatment is equity, right? So what does one need to bear in mind? Usually, it's short-term capital gains, right?
So yeah, so if you're doing STPs for short period of time, then basically you will be redeeming all your money in less than 1 year. So in that case, it becomes a short-term capital gain, and you only pay 15% tax on that. Okay, but if you're doing long-term STPs, and say for example 2 years, 3 years, Okay, a lot of people like to right now keep money for 15 months and 20 months to do STPs. In that case, the whatever money is invested in arbitrage today, and if it completes after 1 year, and when you do the redemption, when you do the STPs, that tax rate will only be 10%. So effectively, you pay 15% or 10% as compared to debt fund where you pay 30% if you fall in the highest tax bracket, or if you fall in the even higher tax bracket, you pay 30 to 40% tax as per your marginal tax rates.
Got it. Let's also talk about STPs and the use of STPs. It's not necessary that it is always beneficial to do STPs. And of course, this SIP Sahi Hai campaign, I think, has been bought into by a very large number of people. It has worked as well. STP is a more nuanced approach, wouldn't you say? So what, according to you, is the ideal window in which you should deploy using STPs, and in which scenarios should you use STPs? Is the current scenario something that is appropriate?
Okay. So STP is basically, SIP is a different concept altogether, because I earn every month. I need to invest every month, and that's where the SIP concept comes in. But what is STP? When we use STP, when I've got a large sum of money, it can be bonus, it can be any large, if I sold any investments and I got a large sum of money, and I need to invest in equities. Okay. Now, normally, if we all know that if you invest in equities and hold for 10 years, you make very good return. But many times valuation also plays a role, that when you should be investing lump sum money in equities and when you should be staggering your investments in equities because the valuations are stretched. So when you're doing STPs, you need to understand that whether the markets are cheap, markets are fair value, or markets are expensive. If markets are very cheap, then you should not be using STP. You should be investing your bulk money in equities at that point of time. So, for example, if you take the COVID times, when markets were corrected by 15, 20, 30%, that is not a time to do STPs. You should be investing lump sum money. When markets are fair value and you believe that there can be some event in the short term and it can be volatile, you can do STPs for 5-6 months, right? But if you believe that markets are really expensive or the valuation are stretched, I believe in the long-term story of the country, but because there may be some volatility in the next 6 months, 8 months, and there are very big events coming in terms of elections and earnings. So in that case, what you do, and because you're not very comfortable investing your lump sum money in equities at that point of time, you should use STPs. So you park in debt for arbitrage fund, and that from there you can take a every month date, and you can keep on doing STPs every month to a pure equity fund. Now, over and above STPs, you should also be using something called a switch. So when you believe that markets are corrected by 10-15%, and those point of time, you instead of only waiting for STPs to keep on going, you can switch your money from arbitrage or debt fund to equity fund at that point of time. So you use STP when you believe markets are expensive, and as you have already heard that last speaker was saying that markets in some pockets are really expensive, and more specifically in mid and small cap space. So if you want to invest in mid and small cap space, there can be some volatility next 1 year, 1.5 years. So in that case, I won't recommend that you invest your lump sum money in those counters right now. Rather, you do a staggered approach of investing in these funds in the current junction.
Okay, fantastic. Now, I did promise at the start that I would take some queries, and in fact, we've got a few viewers that have written in on the WhatsApp number that you can see on your screen right now. Parikshit Kulkarni has got the first question, and he's got a two-part question. The first one, he's listed out a couple of schemes in which he is investing in through SIPs, and this is since 2017. He's got the ABSL Focused Equity Fund, which he's doing a 6,000 rupee SIP in, and he's got the UTI Mid Cap Fund as well, in which he's doing a 4,000 rupee per month SIP. The total value of that currently stands at 17 lakh. The question is, should he stop the SIPs or continue for 15 more years? If yes, which one should I stop, and which new mutual fund scheme should he look at? What's the view here, Nikhil?
Okay, see, both these funds are good in their respective categories. In recent times, they would have underperformed their peer group is more because the allocation what they have. So ABSL Focus Equity Fund has a large component of biases towards large cap, whereas if he's comparing to his peer group, there may be a lot of funds which have got middle small cap, and because of rally in middle small cap, ABSL Focus Fund has slightly underperformed its peer group, and same goes for UTI because this fund also have got 25% in large cap space. So what I rather recommend right now, these funds are good, they're managed by a good fund manager. You can hold on this fund, not redeem in this fund, because in mutual fund there will be phases where one fund will underperform, okay? But every 2 months or 3 months underperformance should not be lead to your changing the funds, because ultimately when you hold the funds and stay invested for 10-15 years, then only you make return. So I'll say that you should continue to hold on this fund and just stay invested. Until you see a change in fund manager and change in philosophy, then you should be changing the fund accordingly.
The second part of his question, and he's asking about more SIPs that he's doing. He's got Kotak Emerging Equity Fund, 5,000 rupees per month. He's got ICICI Pru Multi-Cap Fund, which is doing 5,000 rupees per month. And he's got recently started SIPs. He's got the Nippon India Multi-Cap Fund, the SBI Large and Mid-Cap Fund, and the Parag Parikh Flexi Cap Fund, all of which he's doing 5,000 per month. So he's doing quite a lot of investments. He's asking, since he already has 2 multi-cap and 2 mid-cap funds, should he add another large cap fund, and he wants to invest a lump sum of 15 lakh. Should he invest in these SIPs in a staggered manner, or in other, or how does he do it? And I think that the STP conversation we had earlier is relevant in this scenario. So one, should he add another large cap? And I've got a question on this. He's got a lot of schemes. Should he reduce the number of schemes?
Yeah. So first of all, adding more funds doesn't make any sense in his portfolio because he already has a lot of schemes. And if you look at his portfolio, as I discussed, Birla Focus already large cap, have a good large cap exposure. Parag Parikh Flexi Cap also have a large cap exposure. And SBI large and mid cap will have 35 to 50% in large cap. Multi cap will also have a large cap exposure. So there's no point of adding any more large cap fund in his portfolio. So I will not recommend to add any more funds in the portfolio. Consolidating portfolio, he can do that because he already have an ICICI multi-cap, so it doesn't make sense to add Nippon India multi-cap again in the same category. So I would rather recommend them not to add any more funds in the portfolio. You can consolidate ICICI multi-cap and Nippon multi-cap to one multi-cap fund instead of having two funds. And rest of funds he can continue the SIP as is what he's doing now. And incremental SIP also, if he wants to add, he should add in the similar funds. With regard to lump sum investments, as we discussed already, that it's a good time to do staggered investments instead of putting lump sum money. So he should do STPs, and currently he can look at Parag Parikh Flexi Cap, SBI Large and Mid Cap, and if he wants to add Mid Cap, he can either do Kotak Emerging on UTI Mid Cap and invest in the existing scheme only in a staggered manner.
Okay, I do want to ask, and I forgot to ask you about this. Arbitrage funds is what we discussed as an option to use, but which arbitrage funds, in your opinion, should be looked at? Of course, if you're looking at an STP, you should essentially be doing the arbitrage in the same scheme. So the other question is, you've looked at all of these schemes. Which of these, if he has to consolidate and if he has to reduce the number of schemes, which can he move?
Okay, so first on the arbitrage, I will also highlight one more point. One is that why arbitrage is right now making even more sense is that earlier, I'm saying long back, we had T+5, then we came to T+3 settlement date. Now, then we had T+2 settlement date. It used to take 3 days time from money moving from arbitrage to equity fund. Now we have T+1 settlement date. So basically the money moves in 2 days time itself, right? You have a trading day today, next day there is settlement, and third day money is in your in the designated +0 settlement date. So in that case, the arbitrage fund and the liquid fund will remain more or less similar in terms of when the money gets switched in terms of time frame, when money gets switched from debt or arbitrage to equity fund. So that way, arbitrage makes more sense. With regard to when you're doing STPs, you have to select the arbitrage fund from the similar fund house from where you're doing the STPs. Otherwise, I'm saying in arbitrage fund, there's not too much of research. What you need to know is that arbitrage fund should be consistent, okay, and they should not be volatile. And the fund house should not take a naked equity exposure. They should all the exposure to equity should be pure arbitrage opportunities.
And, okay? And finally, very very quickly, which should he move out of to consolidate?
So I say multi-cap and Nippon multi-cap, he can either choose one fund and doesn't make sense to have two funds. A rest of fund he can continue as of now.
Fantastic. All right, Nikhil, thank you so much for joining in and for giving us that answer and speaking to us on arbitrage funds as well. That brings us to the end of this particular edition of the Mutual Fund Show. It's been a pleasure bringing it to you. Do stay tuned. This is NDTV Profit.